Since hopefully you're viewing this from home and you're having a good day so far, we're going to take a look at the types of credit, and you can always email me if you have questions. So just a reminder, with our distance education, I'm not going to try to overload you. Just want to keep a continuum of education, so we're learning a little bit and nothing to get stressed about. And if you get confused or have questions, just email me through Google Classroom. So some big ideas. You can have good credit. It's going to help you take care of yourself and your family. Bad credit means that you're going to spend a lot more on those loans, higher interest rates, or they may even deny you if you have bad credit or you have not paid your loans back in the past. There's lots of different types of loans, and so today I'm just going to walk you through those. We can classify the loans in a lot of different ways. Installment versus revolving, secured debt versus unsecured, and then when it comes to the interest rates, they can be variable or fixed. Quick review. When you borrow money, the amount you actually borrow is called the principal. The interest is the cost the banks are charging us. They always express that as an annual percentage rate, or a rate for short. And if they try to charge above 29.99%, that would be called loan sharking. That's illegal. Finally, how long are you borrowing the money for? That is going to be expressed as years or months. So a 5-year loan is actually 60 monthly payments. So the best way to build your credit, and I know you guys have already heard this, but always pay your bills on time. That's the number one thing to do. That proves to the bank when you borrow money or you owe money for something like your cable bill or something like that, that you pay that on time. It shows trust. You need to borrow money to get credit, and that first credit card, it'll have a small available credit limit. You want to buy something small once a month, pay that bill on time. You'll even avoid the interest, and you'll build your credit. And in general, less debt is a good thing. So you need a little debt, but too much will actually hurt your credit. Okay, so revolving credit, that's going to be your credit cards. Basically, the card is always available. You can borrow that money whenever you want. That could go on for years and years and years. The banks love that because they know if they give you that endless credit, there's a big chance that you will owe them money from month to month to month, and that's how they can charge you interest. So, yeah, real simple there. There's no end date on a credit card, so it's revolving. It doesn't actually end. It just keeps going over and over. You borrow, you pay it back, you borrow, you pay it back. An installment loan is the classic example would be for college or for a house or a car. So your student loan is an installment loan. You'll borrow the money for school. Hopefully you graduate, and then about 6 months later, you have to start paying it back. And the best way to do that is to pay the monthly payment and try to get the entire loan paid back within 10 years. That can be hard to do, especially if you're using your credit card or you're paying too much for a car or rent or something like that. And then if you decided to go back to school for a master's degree, a PhD, a medical doctorate, law school, that would be a new loan that you would take out. Okay, when you go to buy your car, just be careful. It's an installment loan, but they will really try to sell you an expensive car by stretching the payments out. So make sure that whatever you're buying, it's going to be paid off in 5 years. They will show you the monthly payment, and the longer they stretch the loan out, the lower the monthly payment. So just be careful that you are not spending too much, and pay those cars off within 5 years, because even a nice new car, 5 years down the road, is going to start to break down, need repairs. They get expensive quick. So there you go. Installment loan for a car, and you know ahead of time how much it's going to be. And same thing for a house. The mortgage is what we call the loan for your house. You're going to pay that back probably in 20 or 30 years. So you'll know up front how much did you borrow, what's the rate, and hopefully you'll be able to see how much it's going to cost you. So the amount of the loan is known up front. Okay, Now, another way to look at these loans is, are they secured or unsecured? Loans are secured with collateral. So essentially when you borrow money for a car, if you don't pay it back, the car is the collateral. They will actually repossess the vehicle from you, so they'll take it away. Same thing with a house. The house is actually the collateral on the loan. So if you don't pay the loan, they will actually evict you from the house, and they will, it takes a while, but they can resell that house to someone else. You will still have to pay the loan, so be careful. And just so you know, basically you have about 3 months, and if you are delinquent, you've missed those payments for 3 months or more, that's when the banks can come in and repossess your collateral. So you want to be really careful before you take those loans that you feel comfortable you can make your payments every month. Now, unsecured debt is different. That's going to be like your credit card. The bank doesn't want all the stuff that you're going to buy with a credit card. Obviously, if you're using your credit card wisely for a once a month meal out, once a month filling up the gas tank, they can't come and get those items back. So it's unsecured debt. There's no collateral. Your student loan's the same way. If you don't pay on the student loans, they can't come and take your diploma. They can't take all the knowledge that you've learned. So basically, unsecured loans are riskier for the banks, and they usually will cost you more money. Student loans are an exception because the government wants you to get an education. It's good for society. You'll earn more. You'll pay more taxes. So even though the student loan is unsecured, meaning there's no collateral, the government gives you low interest rates because it's such a benefit to society for you to get education. Okay, now interest rates change over time, and you're going to see that sometimes we have fixed rate, sometimes we have variable rate loans. You'll often have the opportunity to pick one or the other, so it's important to understand that the rates change over time. Right now, interest rates are really low, so most people, when they go to borrow money, they will do a fixed rate because they want to keep that low interest rate. So fixed or variable is just the interest rate on the loan. As long as you're paying your bills on time and avoiding debt, you will qualify for lower interest rates, and then you can hopefully keep those fixed, or you may decide to do variable. Let me show you why. So a fixed rate interest rate, they can't change that rate. So if you lock in your rate at 4% on a house and the interest rates in the world go up over time, your rate will stay the same. So if you think interest rates are going to go up in the future, you can lock in your rate with a fixed rate loan. Now a variable rate, your credit cards are always going to be variable. The reason is that the banks want to charge you as much interest as they can, and because there's no collateral, they found a lot of ways to try to max out the interest rate. So variable interest rates are common for things like credit cards. If you miss a payment or you're late, they're going to just jack up the rate to as high as they can. 29.99 is the highest they can go legally. When you go to buy something big like a car or a home, if you think interest rates are high currently, and you can talk to the bankers, they will be honest with you. Some people will choose to do a variable rate for a car or a home. That's because they believe the rates will go down in the future. Mr. Fisher tends to like a fixed rate unless interest rates are really high, and that would be the only time I would go variable because I'm hoping that in the future they go down. There's never a guarantee with the future, just like investing. We don't know if things are going to go up in value or down. We don't know if interest rates are going to go up or down. So in general, a fixed rate is usually a good idea unless you're in a situation where rates are really high at the time. And that's when you might do variable so that in the future when rates go down, you're paying less interest on your loans. It's just another way to look at these. So, big ideas. When it comes to credit, you're going to need it. It's going to be one of those things that helps you have a better life. Don't buy stuff you don't need with the money you don't have. That's the credit cards. They can't wait for you to fall into debt on those credit cards, and they'll make it very easy to borrow money for little things like clothes, you name it, anything you can think of. Watch out for that. Your college debt is always going to be worth it as long as you graduate. It's very hard to get through college. So make sure if you take those loans and you're committed to getting your higher education, it's not about getting into college, it's about getting through college. You want to graduate. You can always pay your debts off faster. So no matter what kind of loan it is, you can pay additional on your debts. The sooner you pay off your debt, the faster you can pay the debt, the less interest they can charge you. Reminder on a credit card, if you use it wisely, even though they have a high interest rate, when the bill comes, you pay it on time and you pay it in full, they cannot charge you any interest. That's a free loan month to month. They refer to customers that handle their credit perfectly like that as deadbeats because they don't like it. They want you to fall into debt. They want you to pay interest. And it's so easy for me to just tell you to do this stuff, but in real life it is very difficult. So be careful and take care with your credit. What else? Just a reminder, while we're doing our distance learning, keep yourself clean, wash those hands, avoid big groups, and stay active. Just because we're apart doesn't mean you can't go for a walk, go for a run, go for a bike ride. And if you have any questions about our classwork, please just email me on Google Classroom. And reminder, we're just going to post one assignment per week, so make sure you're keeping up with our class. Take care, my friends. I hope to see you real soon.